Well, we're back after a bit of a break here at the end of tax season. So we're going to talk this week again about current federal tax developments, this time for the week of April the 20th, 2026. As always, and as it was last time, this is Ed Zollers coming to you from Phoenix, Arizona. We're looking at things that go on in federal taxes, keeping you up with what's happening in the weeks in question. As I said, it's been a little while. We're going to go over what's happened in the last week so you can get back up to speed here. And we'll just kind of take a look, see what's been going on, and talk a little bit about these developments. So what do we have this week? We have 5 key developments to look at here. We'll do an analysis of the newly issued final regulations for the Section 224 qualified tip deduction. These came out just before the end of tax season. So I think you'll probably be forgiven if you weren't quite aware of what are not huge changes in them, but they're there. We'll also look at proposed regulations to update information reporting thresholds and some significant changes to wagering losses and wagering income reporting, because there's some issues that took place. Some of it is due to overlap with the fact that under the old rules, the IRS had given relief from the reporting requirements for wagering losses or wagering winnings, was not a $600 trigger. The problem now is, though, we've revised the rules federally for most information reporting, and now if we didn't make a change in the regs, technically the regulations for wagering would ask for a lower trigger of reporting. So we had to have changes there. Plus, the IRS has put out the proposed regs on the wagering loss limitations that take effect this year. We'll talk a bit about that. Also going to cover a recent split ruling from U.S. District Court regarding disclosure mandates in the regulations for micro-captive insurance arrangements. It was kind of a split victory. For certain people who are trying to become enrolled agents, right, we have some good news. There will be a reduction in IRS user fees for the enrolled agent special enrollment exam. And then finally, we're going to look at a tax court decision that deals with the constructive receipt of income and investment interest deductions when a life insurance policy is terminated. So let's dive into the first topic this week, which is a technical analysis of the final Section 224 regulations on the qualified tip deduction. These are final regulations under Section 1.244-1, Treasury Decision 10,044, and it was issued on April the 13th. We're going to review these final rules, highlighting some changes from the proposed regulations and talking about the practical implications of these rules. Now, basic note, to claim the Section 224 deduction, qualified tips must be properly reporting information statements. And this is still in this law. I mean, the law didn't change, so the regs are going to follow that rule, and that has complications in the self-employed arena, but we'll get there. The final regulations keep the strict deduction cap at $25,000 annually, regardless of the taxpayer's filing status. Yes, there were some people trying to argue that, we want to kind of read the rule broadly and say that it really meant that each spouse for married joint would get $25,000. That seems to be a stretch, shall we say, or a strained way of reading the law itself, at least in my view. And the IRS didn't agree that it made sense either. We also have the phase-out mechanics are in here. Remind you of those. The deduction is subject to phase-out based on modified adjusted gross income. And that's going to be adjusted gross income plus your, foreign earned income exclusion, territorial income exclusion, and foreign housing allowance in that background. The deduction is reduced by $100 for every $1,000 that a taxpayer's modified adjusted gross income exceeds $150,000 or $300,000 on a joint return. And the IRS added in the final regulations a specific example for married couple filing jointly to clarify the mechanics. The spouses must first aggregate their individual qualified tips up to the $25,000 hard cap. For example, if Mary earns $15,000 in tips and Tom earns $20,000, their $35,000 in total is first due to $25,000 cap before any joint modified adjusted gross income phase out is applied. You don't go all the way to $35,000 and then start reducing, which would give you some basically run out room before you could get to $25,000. IRS isn't going to go along with that theory either, and the example makes that rather clear. Now, the qualified tips, and the voluntary standard. The final regulations made several important refinements to what constitutes a qualified tip, especially regarding payment technologies. Cash tips include foreign currency. That wasn't clear before. But the IRS took a definitive stance that digital assets and cryptocurrencies are specifically excluded from the definition of a cash tip. They are property. Therefore, good news for payroll tax reporting, they're not just going to show up on a W-2. Bad news, you're still supposed to report them as income. And bad news, you can't exclude them once you've reported them as income. So if you're tipping people in crypto, well, just understand there's some tax consequences in that regard to them. Now, the voluntary standard has been a big issue here. And a major requirement is that tips must be paid voluntarily and determined by the payor. This means automatic gratuities and mandatory service charges generally do not qualify for this deduction, even when they're paid to the employee. That's treated when it's a mandatory fee as essentially, the restaurant simply moving part of the payroll expense onto the customer, right? Mandatorily, they have no choice. So that's not considered a tip. Now, there is some clarification here for point of sale systems. If you have clients that are using a point of sale interface, the IRS clarified that preset percentages, and you've seen those all the time, right? They bring you a little machine, to basically they tap your card, they do it, and then on the machine is a tip, and it has a preset percentage, right? That's there, 15, 18, or 20%, or tip sliders. A lot of customers modify the tip down to zero. They'll meet the voluntary standard as long as zero is an option, right? Or at least all the way, at least in my interpretation, as long as, the least one you can get away with, that's mandatory. And then anything above that would be voluntary. A little bit weird. I'm not sure most restaurants would want to deal with that. But yeah, but the mere fact that, they bring in that thing and it suggests a 15% tip or suggests a 20% tip, maybe even has it preloaded so that, if they just hit the button and say go, it'll run it. As long as they have the option to reduce that to zero, you're fine on your point of sale system. Now, some clarification for digital content creators. The rules provide specific guidance for digital content creators. If a contribution is required to unlock content, in essence, you pay X, and you get access to A, B, C, and D. That's compensation. That's not a tip. You sold access to material. However, a voluntary contribution for free contents are qualifying tips. Regulations also helpfully add that giving a superficial token appreciation, highlighting the user comments in a chat window, does not ruin the tip's qualified characteristics. So, when you do those, when you do that sort of thing inside of let's say, live YouTube broadcast, you're a content creator, and you just highlight their content because they paid, they put some money in. As long as you just highlight it, that's fine. That's not going to be a problem. Now, for managers and supervisors, due to Fair Labor Standards Act conflicts, managers and supervisors cannot claim the deduction for tips received through a voluntary or mandatory tip pool. However, if the manager steps into a traditionally tipped role, for instance, a manager who waits tables during a dinner rush, the tips paid directly to them for those specific services do qualify. This will be a bit of a complicating factor for payrolls. So keep that in mind in a restaurant. You've got that for managers, supervisors, and the like. Now we have the anti-abuse rules and self-employment limits. Okay. The final regulations introduce significant changes in the anti-abuse provision, moving away from a blanket prohibition to a flexible facts and circumstances test to catch the recharacterization of wages or service payments as tips. For instance, a sudden shift in historical tipping practice or artificially low invoice paired with an unusually high tip could indicate an impermissible recharacterization. However, there is still an irrefutable presumption of abuse if the tip is paid by the employer or if the recipient has a 5% or greater ownership interest in the payor. This last one was a key problem that a lot of commentators pointed out in the original regs. It said flatly that if you had any ownership interest in the entity that was paying the tip, then that wasn't a qualified tip. The problem there becomes obvious when you think about it. Let's say that you're a waiter, waitress, you're working in a restaurant, and a party comes in who is, let's say, in town. and they're in town on business for Microsoft. And of course, they'll go ahead, they'll put it on the credit card, it'll go to Microsoft, it'll pay the tip. The problem is, if that particular wait staff, that person, let's say, owns any shares of something like an Index 500 fund, they own a minuscule portion of Microsoft, and by the original regulations, that wouldn't have been a qualified tip because they had an ownership interest in the company that paid their tips. Now we're going to move that to a 5% interest. That's a compromise. The theory is you should know who you've got a 5% interest in, and it's going to kind of get away from, being able to route tips by having, the family business, pay tips to to the various kids and have the kids be, less than 5% owners, various other structures. We're not going to get into all that mess. We're simply going to have this go. Now, in this case, for self-employed individuals such as single-member LLCs and sole proprietors who do get the information return, that's still a problem. The deduction is permitted, but it cannot be used to generate or increase an operating loss for that trade or business. For example, if a self-employed manicurist earns $100,000 gross, including $30,000 in tips, and has $40,000 deductible expenses, their $60,000 net income will easily absorb a maximum $25,000 deduction. No problem whatsoever. Now, let's talk about some procedural provisions and a delay in the specified service, trade, or business issue and dealing with those. Procedurally, to claim the tip deduction, the taxpayers must have a valid Social Security number issued before the tax return's due date, including extensions. In the final regulations, the IRS explicitly rejected requests to allow individual taxpayer identification numbers, ITINs, as a safe harbor. Any married couples must file jointly, though the Social Security number is only required for both spouses if both actually received qualified tips. Regarding the specified service, trade, or business exclusion, the IRS in the proposed regulations recognize the complexity for employees trying to determine their employer's SSTB status. That's continued. Consequently, Notice 2025-69 provides broad transition relief, treating the tipped occupations as non-SSTB until January 1st of the date following the issue of final regulations. Lastly, the list of eligible tip occupations is fixed based on the data as of December 31st, 2024. But the IRS did expand the list in the final regs. They expanded that list to include visual artists like ice sculptors, floral designers, and gas pump attendants. So, that kind of background, they made that a little bit clear. Now, about that delay in the SSTB. January 1st, following the issuance of finalized regulations on that specific issue, is the date we're looking for. So it appears we definitely don't have it for this year, and we'll see if we have it next year. So now we have our nice little infographic. If you're listening to this on the audio, you can download it from the Current Federal Tax website on the page we use for the audio and video podcast. You can get the PDF, and this will be there as a slide. You guys who are watching on video can also go get that slide. Among all the other slides, it's there. This is a quick one-page summary of the 224 deduction rules that we just went over, right? It is it's a deduction applies to taxable years beginning after December 31st, 2024. That's going to be an issue as to how we get it. It is below the line. Make sure of that. I just realized I did not prove very carefully at this point for this issue on the Notebook LM generation. Notebook LM, it's weird. It only goes off of the sources you give it in theory, but it does have to go to its third-party knowledge to write up certain things. And unfortunately, it tends to confuse above the line with whether or not you itemize. So no, that's not true in this case. Keep that in mind. But that'll be there, right? So anyway, this is a quick reference, though, the $25,000 hard cap, the income phase outs, and, we're not going to be able to count that cryptocurrency, among other things. So in any event, it's there, it's available. So it's one of those fun little details that we get. And again, only good for 4 years. So that's there. Okay, moving on to our next major topic, is going to analyze the newly issued proposed regulations under Reg 113229-25. These proposed regulations, the Treasury Department and the IRS amend basically, 26 CFR Parts 1 and 31 to reflect statutory changes enacted under the One Big Beautiful Bill Act, or OBBA, which was signed into law on July 4th of last year. And the One Big Beautiful Bill Act made substantive amendments to several Internal Revenue Code sections, and the Treasury issued these regulatory updates specifically to prevent confusion and stop practitioners from mistakenly applying the older, outdated thresholds. Now, be aware, while these are proposed regulations, and while they're only effective upon final publication, the reality is the law applies if the regs don't. So the thresholds will apply for 26, even if somehow these aren't finalized. So keep that in mind. One of the most significant changes is a severe limitation on deductibility of wagering losses under IRC Section 165D. Previously, losses were deductible strictly up to the amount of the gains. Now, however, the taxpayer can only deduct 90% of their wagering losses, and that 90% then is still strictly limited to no more than your wagering gains. 90% cap applies equally to the combined losses and combined gains of spouses filing a joint return. And keep in mind that this specific amendment restricting calculation of wagering losses first applies here in 2026, right? This was not last year. Last year was still 100% for 25. This year, the 90% rule kicks in. And despite multiple statements from the chair of House Ways and Means that he wants to change this and remove it, it's still not removed. And, and especially in election year, it's becoming tougher and tougher to see where they'll get the time in the bill to change it. So I'm going on the assumption right now that we're going down the 90% path, like it or not. Let's talk about the increases to information reporting thresholds. Good news compared to the others. Right. So here's the breakdown of information reporting changes under these proposed regulations and under the Act. The Act significantly amended sections 6041, 6041 Cap A, and 3406 to raise the baseline reporting threshold from $600, a level that dated back to 1954. $600 is worth way more in 1954 than it is today. I'm just going to tell you that. We have raised that to $2,000. This new threshold applies to payments made after September 1st, 2025. Again, this is one of those things that takes effect this year. It impacts forms W-2, 1099 miscellaneous, and 1099 NEC, trust distributions, and healthcare carrier reporting. It's also important to note this $2,000 base will not remain stagnant. There's an automatic inflation adjustment that will begin applying next year, so it's going to go up every year, at least, or theoretically could go up every year. Depends upon how much the inflation moves. Recently, it seems like it might move a bit, so we'll probably have a different 27 number. But we'll have to see how it goes for the measuring period. So let's talk about wagering, winning, then backup withholding issues. New baseline also triggers an administrative cleanup for gambling winnings. Under the old regulations that were published in 2016, the Form W-2G had different reporting triggers, specifically $1,200 for bingo and slot machine play and $1,500 for Keno. Because the new baseline exceeds either one of those, right? Treasury is striking down those specific dollar figures and elevating the thresholds for bingo, Keno, and slots to match the $2,000. Okay. Additionally, backup withholding triggers under Section 3406 are conformed to the new amounts, requiring backup withholding only when aggregate payouts reach the $2,000 threshold. For certain non-bingo, Keno, slot gambling winnings, backup withholding applies if the payout is $2,000 or more and the proceeds are at least 300 times as large as the amount wagered. In essence, yeah, right. Big win, right? In essence, we're not just because the payout. And if you bet, $2,000 on the outcome of a game, right, at a sports, basically, when you went and did the sports betting and they paid out $2,100 because, you were taking the overwhelming favorite. Yeah, we're not going to be forced to report that. However, if you bet on the team nobody thought would win, and so your $10 bet generated that $2,000 winnings, well, then of course, that would be reportable. And that's probably a bet for them to win the Super Bowl, but all of those things as we go on that background. Okay. Now, what is the effective date here? And I said, be careful of effective dates because the law applies even if these regs, that's why there are no proposed or, shall we say, interim, final, or temporary. By the way, it appears that the IRS is going toward a Treasury, for regulation to revenue code, is moving away from calling it temporary regs and moving it to call them interim final. Just going to say when they do that. So these will apply to tax years beginning after December 31st, 2025. And the amendments to reporting and bag withholding apply generally payments made on or after January 1st, 2026. The Treasury issued these updates to ensure regulations reflect the current law, preventing a scenario where practitioners might mistakenly apply the outdated $600 threshold. But there is a word of caution. Nowhere in the preamble does it ever say that you can rely on these regs for 26. So keep your eye out until final regulations are published or further administrative guidance in creating reliance is issued. These are proposed rules, and more importantly, anything that is changed in here that was not directly addressed by the law or impacted by the law, then that's not going to necessarily apply or could be changed. So keep your eye on this. We don't know this is the rules for 27. We do know generally it's got to be because they can't go against the law, but some specifics could definitely change in that background. So again, our infographic again, this time summarizing the tax shift brought on by the One Big Beautiful Tax Act. In this case, breaks on reporting base increase to 2,000 and the reduction in administrative burden. So there's going to be a whole lot of fewer. They're estimating like millions of fewer documents filed when we go from 600 to 2,000. Right, so that could be in W2 1099AC, W2G, and 1099 miscellaneous. We also have the 90% limit on wagering losses is on this as well. So these are things that are kind of covered by these regs. So useful and important. And by the way, the numbers here, of course, come from the preamble to the regulations. That's where we're going to see those. Now we're going to shift to our third topic, which is a recent case out of a Texas U.S. District Court. Drake's Plastic Limited Company versus Internal Revenue Service. This dispute centers around micro-captive insurance arrangements, which allow corporate entities to claim insurance premiums paid to an affiliated captive insurer as deductible business expenses under Section 162A. If the captive insurer meets certain diversification requirements and keeps premiums income below statutory cap, it can elect under Section 831B to be taxed exclusively on its investment income, meaning that the premium income escapes taxation entirely. And so the idea is the operating company pays this insurance to the captive. It takes a deduction for the insurance premium. But the captive, while it picks it up, while it gets that payment, does not pick that up as income, only reports its investment income. So obviously, if it works, it's great, right? We don't have a problem. And as you might guess, looking at math like this, well, what if we just put huge premiums in there and had to insure a wildly unlikely event? And also anyway have, kind of ultimate insurance, backup insurance to cover if the wildly unlikely event should in some way happen. Wouldn't that be a way to effectively just create tax-free income out of thin air? And, and it can go all the way up and we can just pay premiums. And so we'll just claim everything as a premium. That was a concern the IRS had. So we'll do that. So to combat that perceived tax abuse potentials, where affiliated companies merely move money from one pocket to another without generally redistributing risk, that is, there is no real insurance, the IRS issued final rules creating strict disclosure mandates, which taxpayers in this case decided to challenge. And it's going to be a kind of a split, half win, half lose. Win some, lose some, I guess, when we look at this. This is, as we said, Drake Plastics Limited Company versus Internal Revenue Service, civil action number H25-2570 from the Southern District of Texas. And the opinion came out the day after tax day, April 16th. So you've got it. The plaintiffs in this case, which includes Drake's Plastic Limited Company and a firm that manages micro-captives, aggressively challenged the IRS's final rule. The IRS had recently split micro-captive arrangements into two strict disclosure categories: transactions of interest for captives with loss ratios under 60%, and the much more severe listed transaction categories for captives operating for at least 10 years with an adjusted loss ratio under 30%. The taxpayers argued that the IRS was labeling legitimate arrangements as presumptively tax avoidance, which scared many clients, amazing how it does that, and imposed costly burdens. They stood under the Administrative Procedures Act, demanding a complete vacatur of the rules. I love legal terms like that. And an injunction forcing the IRS to destroy or return all client materials it had already submitted. They're not asking for much, especially the second part. Let's go on and see what the court thought about this one. Okay. The U.S. District Court itself, in its opinion, focuses analysis on the precise statutory language of Internal Revenue Code Section 6707 Cap A, which is the section dealing with reportable and listed transactions. The judge highlighted a key difference for reportable transactions, which includes transactions of interest, law only requires the arrangements have a potential for tax avoidance or evasion. The court noted this is a remarkably low legal bar. The avoidance doesn't even have to be probable, just plausible. And I mean, plausible is obvious here. It's clear how you could game the system, right? If you don't worry about the premiums, if you don't, and you make sure that you're insuring something that has little or no chance of happening, then yeah, I mean, it's obvious how you'd use it, right? That's it. But the court balked more on the listed transaction thing. It said a listed transaction deliberately omits the word potential. So it's looking for actual tax abuse. The court concluded that to lawfully designate micro captives as listed transactions, the IRS was required to prove the arrangements with the sub 30% loss ratio are presumptively, meaning in the court's view, more than half the time, abusive and not really for insurance. In essence, where did you get that number? And can you show me that over half arrangements that have that, are going to be essentially an avoidance transaction and therefore would meet the test to be part of a listed transaction? Now, applying these standards, the court split its ruling. It sided with the IRS on the transactions of interest under basically Regulation 1.6011-11. The taxpayer argued 6% loss ratio threshold was overly broad and unfairly captured perfectly legal captive arrangements that deal with high severity, low frequency risks. The court acknowledged that the rule is indeed over-inclusive. It will catch things that aren't really abusive, but ruled that it is not unreasonably overly inclusive. Because the standard only requires to identify a potential for tax avoidance, the court determined that the IRS did not act arbitrarily by using a broad reporting mandate to combat evasion. My assumption in the back of my mind is this is probably a bad thing for the people that filed the suit, especially for the promoter. Because this is the problem. Even a reportable transaction is going to get a lot of people to balk. And while many tax preparers can be a bit bamboozled, shall we say, by a long legal opinion that goes on for 300 pages, and if you ever log all the way through it, you find most often if it's that long, it says nothing, because that's the whole point of 300 pages is to hide the fact it's saying nothing. Essentially, the mere fact, though, it shows up as reportable is going to cause the taxpayer and any of their other advisors to essentially tap the brakes here. And that's probably not good. So from that, I am sure that the plaintiff is disappointed, and I would not be surprised to see the plaintiff appeal this case, looking to get that thrown out. But right now at the district court level, the district court said no problem with that. These are still transactions of interest. They're still a reportable transaction, which means we still going to have to disclose on the returns. The penalties aren't as onerous for failing to disclose a reportable transaction, but they're still there. So, and they, as promoters, going to have to inform the people their reportable transactions. And while your average run-of-the-mill business owner has no clue the difference between a reportable and a listed transaction, all they know is, though, told they have to turn in the IRS, say, hey, IRS, we're doing this. That's going to give them pause. Just saying. So I would expect this to be appealed. I don't know they're going to win it, but I would expect them to appeal this because that was kind of the whole point of taking this to court. But the IRS did not fare as well in listed transaction designation under Regulation 1.6011-10. The court ruled the IRS exceeded statutory authority because it completely failed to present quantitative data proving that captives with loss ratio below 30% are presumptively avoiding taxes. The court rather harshly criticized the agency, noting the administrative record lacked information on how many captives actually qualify under the rule or how many of them are evading taxes. We need some information. We need a backup here. You can't just assert. Your assertion is not evidence, basically what they're going to say. Consequently, this transaction rule was fully vacated. However, the court denied the plaintiff's request to restore the IRS, to basically force the IRS to destroy previously submitted document, stating that this was basically just getting rid of it was a complete remedy, and we don't need to go back and destroy things. Finally, to prevent administrative chaos, the court stayed this, vacatur, stopping the whole thing, until May 1st of 2026, right after tax season. So they said, it's there till then. I would not be totally shocked to see the IRS appeal and ask for this to be stayed for a longer period. We've had back and forth all through this year about, the Supreme Court's view on when can a district court kind of issue a blanket stop. And this appears to be a blanket nationwide stop. So we'll have to see if this is deemed to meet that level. So again, we got our infographic, a summary of what went on here. This is a little cleaner, mainly text, right, of the split decision. It says transactions of interest rules were upheld, which rely on a relationship test, the financing factor 6% loss ratio threshold, to identify potential for tax evasion. From the list of transactions, it was struck down due to IRS lack of evidence regarding presumptive abuse. So you can use this as a quick reference to understand exactly which micro-captive reporting triggers your clients are still going to have to comply with. The issue. Hey, good news, shall we say, for those looking to take the enrolled agent special enrollment exam. It's going to be a little cheaper, right? So the IRS and Treasury Department have issued interim, final, and proposed regulations, Treasury Decision 10045 and Regulation 108-706-25, implement a favorable downward adjustment to the user fees associated with taking the special enrollment examination for the enrolled agents. That is the EASEE exam. So, and these came out on the 17th of April, the end of the tax week, shall we say, for tax day. Federal agencies are required under the Independent Officers Appropriations Act, IOAA, and OMB Circular A25 to review their user fees every 2 years to ensure they are accurately recovering their costs. Following the 2025 review, the IRS determined a fee reduction was warranted. Now, be careful. This is only the government side of the fee. There's an administrative charge from the party administering the exam that's not going to be touched by this. So, there is a 33% reduction of government portion user fee, dropping it from $99 to $66 per year. So the key takeaway is a $33 reduction in what the government's charging. It's critical, though, to remember that the $66 basically covers the IRS direct and indirect oversight costs. Examinees taking the test between May 26 and February 27 will still be subject to the third-party contract administrator fee of $251 per part. That's the big one, right? So, I mean, it's a savings. It's better not to pay $33 more, but it didn't get rid of the $251. It's not like it went from a well over $300 fee to a $66 fee. That's not how this worked. Okay. How did the IRS arrive at this figure? If you're interested in that, they used standard federal accounting practices. They projected their labor, benefits, and overhead costs through 2028 and determined their actual oversight cost per application is roughly $66.43. The decrease is primarily driven by two factors. Improved timekeeping methodologies lowered the estimated administrative expenses, and second, an increase in volume of test takers allowed the IRS to distribute its fixed overhead costs much more broadly. Because the IRS is legally required to recover full costs, but does not intend to subsidize the exam, the fee was strictly calibrated to match this new lower calculation. Okay. Procedurally, this $66 fee applies to the EASEE registrations occurring on or after the date the interim rule is published in the Federal Register, which is designated as April the 20th, 2026. To get this relief to taxpayers immediately, the IRS invoked the good cause exception under the Administrative Procedures Act. This allows them to bypass the standard advanced public comment period, arguing that it would be entirely contrary to the public interest to force candidates to continue paying the higher $99 fee, while the IRS already knew their actual costs significantly lower, merely to get comments on this change in the regulation. The interim final rule simultaneously acts as a proposed rule, meaning that the public still has a 30-day window to submit comments before it's officially finalized. So bottom line, we still have that. And again, our nice little infographic you can hand out to anybody who is deciding to work on being an EA. Maybe you got somebody in your firm who's going down that path, or maybe you are, whatever. This is a new issue. It highlights the breakdown of the $66 fee, which is a government one, and it is a per part fee. But still going to go the out-of-pocket cost of $317 per exam part. It also illustrates the primary drivers behind the fee decrease and shows how the IRS has projected $3.5 million in oversight costs are largely allocated to labor, benefits, and a high percentage of overhead to run the program. which, yeah, overhead's probably the big issue here because, there are not a huge number of EAs compared to CPAs, let's say. And again, the IRS doesn't deal with the CPA exam stuff. That's a state level thing. As we all know, we're CPAs. Yeah, we send our checks to Arizona, right? And we send money to Arizona when you take the exam. Okay, but that makes it tougher, though, because they still got to develop an exam. They still do the work, but they have fewer candidates to spread it over. So that's always going to be an overhead problem here. Finally, let's go ahead and review a recent tax court memorandum decision. This is the case of Jonathan Sawyer versus Commissioner, Tax Court Memorandum Decision 2026-33. Came out on April the 16th. It deals with the tax consequences of a terminated life insurance policy. And this is something that catches taxpayers out all the time. This is an excellent analysis of constructive receipt rules in this area and the strict rule involving investment interest deductions. Now, the investment interest deduction is a unique issue in this case because in most cases, we're probably not going to have any case for arguing for investment interest when a life insurance surrender pays off unpaid interest on a loan against the life insurance policy. But this case is a little different there. So let's look at the background here. Jonathan Sawyer owned a family printing business, HNS, which purchased, and he purchased $200,000 life insurance policy on himself. To prevent the policy from lapsing during tight financial times, he utilized an automatic premium loan option. Now, the company also began to struggle terribly. Right? So in 2009, he took an $80,000 policy loan against cash surrender value and deposited those funds directly into his failing business bank account. Unfortunately, it wasn't quite enough. NHS liquidated in 2010, the next year. By 2015, the combined balances of the $80,000 loan has accumulated premium loans along with unpaid interest eclipsed the cash surrender value, triggering Northwestern Mutual to automatically terminate the policy. While the $205,403 cash surrender value completely satisfied the outstanding loan, his actual investment in the contract, the premiums he'd really paid, were only $44,500, resulting in a taxable distribution of nearly $161,000. Now, he didn't file a return that year, right? Because he thought, I didn't get anything. There's nothing could be taxed, right? Well, 1099 came out, of course, and the IRS noticed. So the IRS issued a notice of deficiency. So now Mr. Sawyer is in court challenging the IRS claim. Just seems it's unfair, right? Let's talk about policy ownership and constructive receipt rules. Now, Mr. Sawyer argued against the deficiency on multiple fronts. First, he argued that his defunct business actually owned the policy at the time of termination. Therefore, the business would have had the income. We don't really have a lot, So let's assume that was right. Let's assume it was a C Corp, just so we can get it someplace we wouldn't be taxed. The tax court ruled because he never provided the insurance company with the required written proof of transfer, he remained the owner of the policy. Under the policy, you had to notify the company if you transferred ownership. He never did that. He has some notes indicate he intended to, that's what he planned to do, and that's what he thought he did. But he didn't follow through with the details, and that's important here. Now, right. He also argued that he shouldn't be taxed because he didn't receive a single dollar. There's no money. I have nothing to pay the tax with, right? The court rejected this, right? Its side established precedent that an indirect distribution of an insurance policy's cash surrender value to extinguish policy debt is a constructive dividend distribution. Under IRC Section 72E5, non-annuity amounts received in excess of the investment of the contractor, including gross income, even if the taxpayer never gets a dime. This is the problem. Right? He owed that interest. Right? He owed that interest. He had borrowed against the policy. Right? Life insurance policies are tax deferral options. And they create totally tax-free income too, as long as you expire before the policy does. If the policy expires before you can end up, and your client can end up in Mr. Sawyer's situation. Because over the years, never paid interest on the policy loans, never paid back the policy loans. Obviously, it was no force to do so because the cash surrender value was large enough. But once that cash surrender value, the policy loans and interest began creeping up to cash surrender value, the insurance company will terminate the policy, right? To use that to pay off the loans, which is what they did here. One of those things. Now, Another argument that Mr. Sawyer tried, he asserted distribution was taxable. He should at least be able to deduct the interest he paid on the loans. Now, the court split its analysis here because there's a couple things. Because $80,000 policy loan was directly traced to Kaplan Fusion to his business, and because corporate stock generally produces dividend income, the underlying stock was considered properly held for investment. Therefore, the $40,000 in accrued interest on that specific loan was deductible as investment interest under Section 163H2B. Conversely, the court rejected any deduction for premium loan interest. Relying on the regulatory history of the Tax Reform Act 1986, talk about going back a ways, the court noted that Congress explicitly intended for interest on a loan used to purchase a life insurance policy to be treated strictly as a non-deductible personal interest. The committee report specifically used this as an example of personal interest. So now, of course, the other problem he's got is got investment income to use investment interest, but that's a different issue. Finally, we look at penalties, right? They were assessed against him. Now, he sought a reasonable cause of abasement for both his failure to file and his failure to pay. Now, the court sustained the failure to file penalty, noting that his separate W-2 wage income independently meant he had to file regardless of life insurance issue. So you had to file. You didn't. Turns out your tax was way higher than you thought it was, but, tough luck. That's it. You should have filed and you didn't. You failed to file. However, in a win for the taxpayer, the court did grant relief from the failure to pay penalty due to severe undue hardship. The court observed that Mr. Sawyer was in extreme financial distress. He had exhausted all of his personal assets. That's why there's no longer life insurance policy, too. Sold his home to avoid foreclosure and had his wages garnished for the business' unpaid payroll taxes. He hadn't got anything. The court ruled that while his normal wages were foreseeable, the massive phantom income generated by the policy cancellation was not reasonably foreseeable. That established reasonable cause for his inability to pay. Therefore, the failure to pay penalty, bad news, a much lower one, is going to be granted reasonable cause relief. Finally, the infographic is a visual summary of the case that we just took a look at. It's a resource to indicate we've got our phantom. So if you can see this, you see our phantom on the left side, right? This is the phantom income, right? Phantom income is, and generally it's not truly phantom because you got deductions or you got benefits. There are reasons why it's not, and we as accountants understand that, but clients don't, and all they see is they're paying tax and got no money. So if we take that as our definition of phantom income, which is how the clients are going to view it, then this is a phantom income issue, right? And the constructive receipt of $160,900, right, was essentially part of this, right? He didn't get his ownership transfer done, right? And then it finally looks at the interest split, how he split the interest between the two. Also talks about, the reasonable cause, the penalties, and why the failure to pay penalty got reasonable cause, but the failure to file didn't. Those are the key issues. Well, that concludes this week's update on current federal tax developments for April 20th, 2026. Thanks for being here today, going over this. If you have further questions, additional clarification on things, you can go ahead and email me at edzollers@currentfederaltaxdevelopments.com. That's on the final slide. Again, and you can download the slides on the website, currentfederaltaxdevelopments.com. Go ahead to where we have, the updates, and you'll find this week's will be there. Also, we are going to, and also basically I do follow along on the sites, the Connect sites for the Arizona Society of CPAs, New Jersey Society of CPAs, Illinois and Minnesota Society of CPAs, and Washington, along with Idaho. So if you post something there, I may see your question. I may post an answer there. So if you're on one of those, you're going to post there. Otherwise, thanks for being here this week. And we will hopefully see you next week with more current federal tax developments.